Hello and welcome to the Global View on this Monday. Well, let's take a look at the bigger picture first. And the US has narrowly avoided a partial government shutdown, with Republicans agreeing to pass a short-term funding bill, pushing the risk of shutdown to mid-November. Meanwhile, the macroeconomic picture has seen underlying US inflation pressures moderate in August, with the personal consumption expenditures price index, which excludes food and energy, increasing 3.9% on an annual basis, the first time in more than 2 years it's fallen below 4%. And that data reinforced the view of New York Fed President John Williams that the central bank may be done with rate rises, saying, "My current assessment is that we are at or near the peak level of the target range for the federal funds rate." Well, US Treasury yields were lower on Friday with key inflation data for August, reinforcing expectations the Fed may be done hiking rates. The US two-year yield was at 5.05% and the 10-year at 4.57%. Meanwhile, data also showed headline inflation in Europe rising more slowly than expected and at its lowest level in 2 years. Consumer prices in the 20 countries that share the euro rose by 4.3% in September from the 5.2% a month earlier. All right, for more on the macro picture and the latest out of China and how it should be influencing our investment decisions, Dr. Joseph Lai joining us from Ox Capital Management. Joseph, great to catch up with you again. Thanks for joining us. All right, well, let's start in China. Of course, China on holidays this week, so maybe an opportunity to take stock of exactly what's going on there. Is the property market still what you're focused on at this point?
Yeah, look, I mean, the property market has been in a bit of trouble in the last few years. And I think the picture is getting clearer and clearer in that, the economy is going through a big property market adjustment. A lot of it is self-induced by the authorities. And we're seeing the fallout from that, gradually. It's pretty clear. It's not, the country is undergoing a structural adjustment, and the rate of growth is going to be slower. However, having followed this fallout for the last 2.5, 3 years, it looks to us that a lot of the worst in terms of defaults and you're worrying about the system. It seems to be really in the review mirror. What we're looking at, I think, the most likely outcome is just a muddling through scenario. The country continues to grow at, I guess, at a much lower rate than 5 to 10% that we're used to in the last 20 years, but nonetheless still growing. The asset market has fallen. I mean, we find it very hard to actually find anything that resembles a bubble in China these days. So in a way, from a bit of sort of a contrarian, quality stock picker like ourselves is actually not such a bad place. I mean, there seems to be a lot of interesting things to look at anyway.
Okay, so perhaps seeing some opportunity there, particularly in terms of the valuations. Which sectors, or where are you looking then for that opportunity in China?
Yeah, sure. So really, it's quality stocks with long-term growth. The economy is going to continue to grow, as I said, slower. Some of these strong companies, most very, very, very likely will be much bigger in 3 to 5 years. I mean, it's just not. I mean, these companies are not disappearing, right? And so really, we're looking at stuff like electric vehicle segment, the components for electric vehicles, alternative energy, healthcare, which is so far has been undersupplied in China, but the coverage for healthcare has been increasing quite quickly actually in the last 3 to 5 years in China. And some of the stories about the local companies taking market share from I guess from the global players in a way they're forced to do that more or less, given some of the sanctions that's applied to them. So there are long-term growth stories that we're looking at, and in fact happy to have been adding in the last month or so, given there's so much despair in the market. And because cars, we've been doing this for a long time, so so if we go back 15 years or around 15 years actually after the global financial crisis, I mean the market in most developed markets or developed and developing markets were extremely cheap because of problem, exactly very similar problem with the property market, but it was worse then because the banking system was frozen. But at the end, one would have loved it to have owned, stocks like Google or Amazon or something like that in the aftermath of the collapse in valuations. So I guess this is more or less what we believe we're at with respect to China.
All right, so that's China. Let's perhaps look more globally then, Joseph. What we're seeing, particularly at a macroeconomic level, and inflation having been the key, of course, most recently. But are we now at that point where we can move on? Although there's an acceptance, particularly I guess in the States, that those rates are going to remain higher for longer. We're seeing that reflected in those bond yields at the moment. So how should that affect our investment decisions?
Yeah, thanks. So, we've been looking at, we do look at a macro point of view as well, because it affects what we do, even in terms of asset allocation. Look, we are a bit more negative than beginning of the year for sure, and the reason is sort of again, getting increasingly expressed in the market. So we've actually hedged a bit of our portfolio for about 2 months now, with the concern really was that our view of the world was different to what people were talking about. We're looking at, and particularly with respect to inflation in the developed markets. If we look at, and the reason why we're more negative is for a few reasons. One is just that if we look at the base, the low base of 2022 in the last, I guess, second half 2022, the base was actually quite low if we look at the inflation index itself. And so it wouldn't take much for the inflation rate year on year, compare end of this year to the end of last year to actually gap up from the current 3.8 whatever percent, or around 4% at the moment, to 5 or 6%. And the second reason to be more concerned was just the oil price. So far this year, the oil price has been in a weak or in decline until recently, right? So in the last 1 or 2 months, the oil price is up back up to about 95, depends on which oil we're looking at, $95 or so US a barrel, from about 60 something dollars. So that's gone up a lot. So we've got a low base last year. We've got a rising oil price, which tend to impact inflation rate overall. And then the narrative most likely would change into higher for longer, which is coming through now. But we'll see. I mean, if oil price goes higher from here, and if we see year-on-year inflation to really come through in September, then I guess there'll be more worrying for the sector of the market, which has benefited from this deflationary narrative, which we believe is those big tech stocks in the US.
Oh, it's going to be interesting though, just how central banks interpret what they're seeing with the oil price at the moment. Obviously, it's that headline number, but perhaps see whether they look through it into what's going at with core inflation there, how sustainable these higher oil prices are at the moment, and just whether we're going to see it, well, just how inflationary it will be.
Yeah, I think so. I mean, look, it is not a foregone conclusion. The high oil price is going to drive long, the core numbers, right? I mean, maybe it is a transitory thing, and I hope it is actually. But we'll continue to look at it closely. What we've seen though is the oil price has tended to impact inflation rate generally, at least on the margin. So that is something that I guess is hard to know with anything macro, to know exactly what the outcome is.
Mm.
And I guess the scenario is that okay, we've got inflation on one side, and the other side is, well, if inflation stays highish, doesn't say that, let's say that it doesn't shoot up to 6 or 7% because of the base, because of oil price, then still, I mean, we're seeing higher for longer probably. So the market's expectation of an early rate cut probably not likely to come through, and then we've got a world that actually, generally speaking, is slowing down. So I guess the base case, and in fact the more base case optimistic case is, look for businesses. If you're a stock picker, look for businesses with sustainable growth, and pay attention to the valuation. I mean, that's what that's what we have decided to do, for sure. To be much more disciplined on that.
So are you therefore more cautious about those sectors, those companies in particular, I guess, that have benefited from that disinflationary trend?
Yeah, sure. So if we look at some of the valuations in some of these markets, I mean, everyone talks about those big stocks, right, in developed markets or in the US. I mean, they've gone up a lot. I mean, from March this year, and so in March we sort of, I mean, I was actually quite positive on those things because, yeah, the world seems to be slowing down, interest rates gone up, and there's a lot of concern about recessions, right, in US and Europe. And I thought, well, sure, but the world's actually still holding up. And then actually we're seeing CPI coming down from about what it was. I mean, it was like 6, 7% or even higher to I believe, based on my numbers, to like 3 or 4%. In the next 6 months. That was, I'm talking about, about in March this year. That's what I was thinking about. But from this point, I mean, we are talking about that these stocks have rallied a lot. And the valuation, I think it's hard to say they're cheap. I mean, maybe one can't say that they're ridiculously expensive. Yeah, sure, reasonable fundamentals. But we have the stock price have gone up. The stock prices have gone up. Inflation rates unlikely to come down, if not go up. And an interest rate cut, there's some expectation of rate cut, I think, if you look at the forward forecasts in the market. It's unlikely to come through, I mean, early next year, which some of the market forecasts have become now. What is likely, though, if they do cut rates, it probably means a much bigger slowdown than we're expecting, which can't be good for markets, I think.
Joseph, great to get your perspective. As always, thanks for joining us from Ox Capital Management.
Thank you.
All right, that is the global view. Just before we go, let's check where we're likely to get going in just a few minutes' time. As you can see, it will be negative, according to SPI Futures, which is off more than 0.5%. Stay with us, the open just around the corner.